Hello everybody and welcome to Green Star Trading with me Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right then, today we're going to be looking at the S&P 500 using our proxy for SPY ETF. We're also going to be looking at the PCC and the VIX. You'll have to forgive me if my voice gets a little hoarse. I've got a cold at the moment, it comes and goes, and if I'm coughing excuse me, and spluttering into the microphone, apologies in advance. We're just going to do the best we can. Right then, we've got a bullish primary, we've got a bearish alternate, and we've got a few other ideas we need to go over as well. So a quick recap in case you're new to the channel. I'm not doing that many updates lately, so I think it might be worth just going over some old ground for a minute. We know that I've been bullish for quite some time. We were looking at the strong divergent lows between June 22 and October 22 and anticipating a rally off of that low, and we started counting it bullishly since those days, and we're primarily looking at this as a bearish completed correction and the move off of that low as a bullish move into a new move to new highs, and that's what I've been anticipating, and that is roughly what we've been heading towards. Now that account has evolved somewhat. If you go back a couple of videos ago, I talk about how the 1, 2, 3, 4 idea got invalidated on this chart. We had problems with the length and structure of this wave 3, lack of momentum, lack of suitable extension targets, lack of strength, all the things which would point to it being a wave 3 which were not present. Also the depth of this correction coming to the golden zone, 61.8%, very unorthodox, very unusual for a wave 4. So the count got shifted and we had to change to a bullish alternate. Now you might say, well, why didn't you change to the bearish alternate? Well, probabilities are probabilities, and it's still far more likely that this is a bullish count than it is a bearish one. I'm trying not to be biased, just generally trying to work with which is more probable. The better explanation is a bullish explanation rather than a bearish one. But we do have a bearish count in mind as well as an alternate, and we will talk about that. We must never discount it completely because it's always possible. So essentially what we've ended up with now is a wave 1 into 2 at intermediate degree and a wave 1 into 2 at minor degree, and we're now into wave 1 and wave 2 at minute degree, looking to extend into a wave 3 higher. So a very strong bullish move to come to new all-time highs, but not before a significant retracement, one would think. Now I can't anticipate exactly when that's going to come. We're getting overbought on the daily time frame, significantly so. We're running out of momentum. On the 4-hour, momentum's already slackening off considerably, and we've got a bunch of damage in this rally here, serious daily sized gaps which need filling. So we will come back eventually, we will get a retrace, and that will be a significantly, if you believe in the bullish count and that's your preference, that would be a good opportunity to buy. If you think you're topping out up here and you get 5 down and 3 back, that could be a very good opportunity to short. There's always ways of making money safely over the short term without getting married to a long-term idea. Right, so just reiterating that point, sometimes I think we all get a little carried away, and I think that's definitely been the case in this rally. Now why do I say that? Because from my perspective, and I've been through many rallies and many bear markets over the last decade or so, this has got to be one of the most hated that I've ever participated in. There is just genuine confusion, vitriol, frustration at the market going higher, which is all a bit peculiar because surely you want to own stuff and you want it to go higher. So there's a lot of angry bears out there who can't believe what's happening in this one. Now that's fair enough, there's always angry bears about, there's always euphoric bulls about, right? And both can be very intolerant of each other's views, but the simple fact of the matter is we are currently within 6% of the all-time high. That's all it would take to move up from here. That's the move up it would take, right? Measuring down, that's 5% off the highs. 5% decline, that's all we're talking about where we are now. So we're basically there. Okay, so if you have been against this rally the whole time, you've missed it's not been the most rip-roaring one, but you have missed 30% gain, which in the S&P is no joke. Okay, so I'm of a bullish bias. I know it sounds like I'm running with the herd, running with the bulls here, but the simple fact of the matter is after a significant correction and a massive sell-off, especially in some of the big names that we saw, the same was true during COVID, the same was true during 2018 power pivot, the same was true when Trump was elected in 2016, right? You don't turn your nose up at those kind of sell-offs. Not in the major markets. You buy them and you get rewarded for it, and that's happened again here. Now, it doesn't mean that it can't all go wrong, it doesn't mean that it can't implode and all collapse, but there's no point anticipating doomsday scenarios when all they're going to cost you is money in the short term if you do. Better to just run with the herd while it's running. It's just the better option, in my opinion. It doesn't always have to make sense, it doesn't always have to be clever, it doesn't always have to be rational, and it certainly doesn't have to match up with any fundamentals, because markets just don't give a shit. At all. Seen it so many times where they just don't care. But anyway, I digress, I'm getting distracted with fundamental arguments. So, let's now look at the bullish count first on the daily time frame. So, we've now got intermediate 1 into intermediate 2, flat structure, and then we've got a 1 into 2 as a double zigzag at minor degree, now anticipating a 1 into 2 at minute degree. I'm not saying it's topped out yet, but it's going to top out sooner or later, and then we'll be off in the 3 to new highs. Okay, that's how I see the primary count. Now we have got, as I pointed out, some serious damage to repair in the chart here on the day time frame. Gap, gap, gap. Now, volume declining, daily time frame, momentum starting to wane, long way from turning bearish yet. We haven't crossed over average for the signal line yet. We are back above the downward trend in the ABV. Okay, we've cleared those prior pivots, as we have done in price, and we're approaching a potential back test of the bullish trend prior. Okay, so we're getting ripe for a pullback at some point. Now, like I said, we don't anticipate it, we wait for the move down and the move back, and the opportunity then you've got, depending on how you come down, you might come down in 3 to here, right, and then you're looking to continue the rally to get in. 5 up, 3 back, and off we go. Well, that would be a new low, so that wouldn't work, but you see my point. And the same if you wanted to short it, right? You can look for that first impulsive move down, that first corrective move back, and there's your short entry. There's always a way to play it over the short term with a relatively good margin of safety, and go with the momentum the market currently presents, be that bearish or bullish, and not obsess or get married to the long-term count, but just make some bloody money in the short term. Right? I would encourage everyone who's trading to do that and to learn how to do it effectively, because it takes you out of the argument, and we should all be avoiding the argument, in my opinion, and just focusing on doing that instead. Longer term and how you're exposed to the markets, you have to have some conviction in what you believe is going on. But anyway, I digress again. We're going 1 2 1 2 1 2. That's the bullish count. We're expecting and anticipating a correction soon. Now this count gets invalidated at 409.21. That's because if this is a wave 1 and a wave 2, we can't come back beyond where the wave 2 completed, where this wave 1 at a lesser degree began. So that's the bullish count, the primary. Now let's have a look at the bearish alternate. Now this one, now this one is the best I think I can come up with, to be honest. Now the reason why I've gone with this as my bearish alternate rather than trying to get the price to collapse prior to the all-time high, which seems to be the thing that the bears still have a hard on for, but I just think you're hoping against hope at this point, is it doesn't technically look right. Given the way I've counted this move down here, this is not a motive structure, right? It is not a legal expanding diagonal. It doesn't matter, but it looks like one. It's not a legal expanding diagonal, so it's not motive, and it certainly isn't an impulse. So this is corrective, right? So if this is corrective, we could have a double zigzag on our hands, comprised of complex double zigzags itself, or maybe even a simpler one. But the problem with that is if this was the subsequent high, so if this was WX, right, going to stay below the high, come down in the Y, You'd expect an impulse here at least to either get a 1 or an A, so you go B and C. But we haven't. We've had another corrective structure here. And once again, you can draw a nice little contracting lines around and say, oh, that's a leading diagonal. No, it's not. It's not a legal contracting diagonal. This wave 3 is too long. Okay, so this is also a corrective structure. So trying to make this motive is cheating. Trying to make this motive is cheating. They're not motive structures. Not given the rules of Elliott wave. And if you're following the rules of Elliott wave, and you should be if you're practicing it, you can't cheat that. So if that's corrective and this is corrective, right, it stands to reason that why can't this be corrective? I'm not saying it has to be, I'm just saying it's my preference, because why have I gone with that as a preference? Well, if this is a zigzag and this is a double zigzag, then this is W and this is X and this is another zigzag into Y into B, and then 5 waves down to new lows in C. This not only technically feels probable, or more probable as a bearish case, it also feels fundamentally perfect as what you'd expect to happen, because all the bears who put their stops above here, above the all-time high, and been short ever since in one way or another, or maybe it's this or high if they're being a little reckless in the short term, then let's say there's a lot of stops here. So there's a lot of liquidity right above this level here, right? The B wave coming out expansively as it does in the flat basically tags all of that liquidity, because it wipes out all of those bears who didn't think we were going to see new all-time highs. Right? They all get smushed, right? And it has the added benefit of grabbing in all the bulls who think we're off to the moon. Right? We've broken out above all-time highs, we're going to run, yeah, and they all join in. So you create a whipsaw in the B wave where you get a sudden surge of bullish liquidity with the liquidation of all these shorts, right? And that could be pretty extreme. B waves can go to 123.6, 131.8, 161.8. They can go a fair way up, right? And then you grab a whole bunch of sell side liquidity as a whole bunch of buyers come in above the previous all-time high, right? A lot of people to sell to above that level, in other words. That's what you'll get as the herd arrives. So this scenario creates the perfect fuck you to everyone. Fuck you bulls, fuck you bears. You all get burnt together. You know, because the bears, I've seen this so many times. Saw it during COVID, saw it during 2018, saw it during 2016, saw it during 2011. Even the rallies off the GFC had similar behaviour. We didn't get the big whipsawing retracements, but we still saw similar psychology, which is once burnt, twice shy. You know, you just had your confidence knocked because the impossibles happened. You see, and that hurts bulls and that hurts bears. So, bearish alternate, all of that was a corrected pile of junk. All of this is a simple zigzag. Okay. Or a double zigzag, depending on how you want to look at it. Off to the highs. And then we get a big 5-wave devastating structure down here. Okay. Bears get smashed as we go to new highs. Bulls get trapped at them. Everyone gets bricked on the way down here. Okay. Apart from us, because we'll be on our toes. Right. Because 5 down and 3 back is 5 down and 3 back. Just as it is here. Just as it is here. Just as it is here. We can always short. Okay. 5 up and 3 back here. As it is here. As it is here, or will be, is always a long opportunity, and we can always get our stops in place to protect ourselves and just trade the momentum over the short term. So that's the bearish count. A down, B up. Now we're not done, because there are other ideas as well. So the older bearish count, which we're now going to have a look at here, was the idea that we had that W, X, and now we were going A, B, C lower from here, and this was the X wave in below the high. The only way I could get this to work, given the structure we've seen here, right, was as an expanding diagonal. 1, 2, 3, 4, 5. A, B, C lower. Hasn't worked because the 4 has now come back beyond where the 2 terminated. This cannot, and literally cannot happen. Alright, given Elliott wave rules, so that's not possible. Okay, and as I've already mentioned, there are people who've put a line here and they've put a line here and are claiming that that this is a contracting diagonal. But this is 1, 2, 3, 4, 5. It is not. If we measure the length of that wave 3, it is longer than the wave 1. Wave 3 has to be shorter than wave 1 and wave 5 has to be shorter than wave 3 as those lines converge. The structure is not enough to justify it being a leading diagonal. Same as with an expansive structure, but in reverse. You know, wave 3 has to be longer, wave 5 has to be longer than 3, wave 4 has to be longer than 2, so on and so forth. The opposite of a contracting diagonal. Either way, neither are now valid. So that's off the table. So what does that leave us? That leaves us a bullish alternate. So this is the lowest probability bullish count I can come up with. And this harks back to a very old count, which was the first idea we had off of the low back in October 22, which was this is 1 into 2, this is also 1 into 2, this is 3 into 4, this is 3 into 4, and this is 5. Extremely brief, extremely short, extremely shallow, and obviously smaller wave 4s at the same wave degrees. I don't like that at all. I think it looks awful, right? But that gives us the possibility of going into 1, W, X, Y into 2, and off into 3. It also opens up the possibility that what we've actually had here is a single zigzag into A, that's the orange, a expanded flat into B, and then C lower to get the 2. Now if that happens, you know, you're put in a situation where you've got an explanation but you just have to live with it, right? Because as I said, coming off of that high bearishly doesn't work. Sideways behaviour here, we'd probably be having to look at an alternate bearish count to explain what's going on. This would be the bullish explanation, but it looks shit, putting it simply. So let's hope that doesn't happen and our lives stay a little bit simpler. Alright, so quick summing up, because I know I've waffled a lot. Bullish primary, we've got 1, 2 at intermediate, 1, 2 at minor, looking for 1, 2 at minute, expecting and anticipating, but not trading anticipating, mentally anticipating a wave 2 pullback at minute degree. Could be deep, could be shallow, could be simply a test of the backward trend here. Okay, might want to just come back into all this prior structure where we've got lows and highs and lows and highs and lows, and come back into the obvious support around this volume node here, back test the trend perhaps, and then we're off. That might be all you get. You might get something a bit deeper and a bit scarier, come back towards the prior lows and all this structure. Okay, either way, we don't know that yet. If you want to be short, you'll be looking for 5 down and 3 back off of that daily divergence or that 4-hour divergence, the weakness during the top. You want to anticipate it on the smallest time frame you can that's reasonable and take the smallest amount of risk with your stop above that level. Then you can come down in an ABC or a 1, 2, 3, 4, 5, who knows. If you don't want the hassle of trading it short term, you can just wait for the pullback to occur, wait for the first move off of the low and back 5-3 in the opposite direction, and you can trade that long. Short term, that's how you should probably approach it. So that is the primary count. Bearish alternate, we're off to new all-time highs anyway, and we'll do it as a zigzag. Now we may do it 1, 2, 3, 4, 5, A, B, C, right? Or we may just go straight off there now. We might just go A to new time highs, B, and then C, and get everyone euphoric and crazy. Double hit the bears as they get trapped in this liquidity block here, because they'll be trying to short this new high just as they get turned around and walloped again, and this will bring in even more bulls just as the break of the previous high did. Okay, you know, just hurt as many people as possible. That's the bearish alternate, and then you'll come down in a massive 5-wave structure which will last way out into 2025, probably maybe even longer, right? Because that becomes a gigantic correction at that point. Finally, you got this bullish alternate, which is that we've had 5 up here in a very peculiar structure, but legal, just a bit weird looking. Alright, and you've had 5 into 1, you've had wave 2, and then you've got the option of, instead of going 1 2 like in the primary where we go off here, we're actually gone A, B and C to another low, and we get a bigger intermediate degree correction here before pressing higher. Now that could also be a corrective structure, right? That would likely be the best bearish explanation, which is this was corrective, this ends up to here being corrective, and then we come down in the 5. All of that's possible, and we'll worry about that as and when things start to break down, if they break down. So there's your various counts. Okay, so now let's just do a little bit of a classical analysis here and throw up a few other ideas onto the chart. So I just want to take the opportunity here to say, let's say we're not Elliottians and we're not thinking about everything in 5s and 3s and ABCs and WXYs and so on and so forth, and we're just looking at the chart. So we know that everything happens in waves. We know that as Elliottians, but we also know that things happen in 3s, they happen in 5s. Now let's say you don't know any of that. What kind of thing can you look for, and should you be looking for, every time the market moves up and every time the market moves back? So let's take this swing here in isolation, and I just want to point out how technical this rally has been, this bounce from here, and why, rather than getting bearish as this comes down, why we should be preparing to get bullish. Even if our longer term opinion is that we will go lower, there are always clues that we're approaching a bounce, that we are approaching a rally. Right, so just talking about levels first, let's take a Fibonacci retracement. So here's the golden zone, 61.8 to 65, straight into it, wicked, bodied on the 61.8, boom. Whenever you come back to the 61.8, no matter how you're counting it, no matter what you're anticipating, you should be at least anticipating a reaction. Whether it's down to go up or up to go down, you should be always anticipating some kind of reaction, because we're looking for a series of confluent factors. The next thing, the first thing is 61.8. What next comes in those confluence factors? Well, how about some support in the most basic sense? So what have we got here? Well, we've got previous lows, previous highs, previous highs, previous highs, previous highs here, and previous lows going all the way back here. Right, so we've got a lot of horizontal support. It's never perfect, it's never exactly to a point, but it's all there. Highs and lows, resistance and support. Okay, at the 61.8 we're coming back into major support. What else have we got? Point of control here in this volume node is bang on the 61.8% as well. Now that's because, as I've just pointed out, all these interacting levels of highs and lows. If you're coming back to major support, which was prior resistance, and it happens to line up with the golden ratio, okay, and it happens to line up with localized volume, you should be anticipating some kind of reaction. Now, the next thing we can look at, which I don't tend to put too much stock in, but it does come up here, is if we take a fib time from the top of that move up, we can see that we bottom at the 618, between the 618 and the 2. Now the 2 means equal length. This length and this length, 1, 2. This is 61.8%. Excuse me. Let's turn that off before it interrupts us again. This is 61.8% the length of that rally, which is also a golden ratio again. So a little less important, I feel, than the fib retracement, but it's still something of interest. So let's continue to add to our little confluence, our little bag of confluence we've got going on here. We've got fib retracement, we've got point of control, we've got major support and resistance, we've got fib time. So now let's look at divergences. So we'll start in the daily time frame, but given the size of this correction, it's not huge. We need to check smaller time frames as well. But let's have a look at what we're seeing here on the RSI. So, do we have divergent lows? First question. Well, let's have a look. Yes, we do. We have higher lows in the RSI, and we have lower lows in price. So 61.8% retracement, point of control, support, la-di-da, bullish divergence. More reason to anticipate a bounce here. Okay. Do we have it on the MACD? Let's have a quick look. Check that is in the right place. Yes, we do. So we have bullish divergence on both momentum and relative strength. We can see how the bearish momentum, although it strengthened here on the histogram, okay, it weakened here, hence the divergence. Okay, so we had plenty of prior warning that we were going to bounce from here. Okay, not the clearest in the world, because it's a shorter time frame, but it is there. But how about we come down to the 4 hour and have a look how it appears there. So now let's have a look at the RSI again. Now we can see the divergence a little more clearly at this scale. It's present. The MACD, it's also present, a little clearer as well. But interestingly, what about the ABV? Well, on this time frame, coming down a little bit, on the 4 hour, we actually have divergence across all three of our indicators here between these lows. Okay, so more convergence, more confluence again that we're about to rally. Right, so what else can we add to our little confluent factors going on here? Well, let's come back to the daily time frame, see if anything significant happened to our exponential moving averages. So we came down to the 250, tested it with the wick, broke it with the body, snagged it, and then fell through it. Right, so we know that on the daily time frame, a break down through the 250 exponential moving average is a significant break in terms of we're getting very sold off, or we're getting significantly oversold. Now, it's not the same as looking at the RSI and looking for divergence, but it's generally, as a basic rule, that if you come all the way back to the 250-day exponential moving average, shit's getting oversold. Okay, so here's the test of it. Here's the breach of it. So similarly, let's look back at the highs in January 22. Here's the test of it. Here's the breach of it. What did we do next? We went higher. We rallied. Now, we did subsequently come to new lows because we were now in a bear market, but the immediate reaction after doing that was that we were getting a little oversold. We were getting a little too extreme, and we had to rally. Well, the exact same's happened here as well. So not in any way a strict science, this one, just another little thing to think about, that when we come back to that 250 exponential moving average or through it, we are pushing things to the downside a little bit much, at least in the short term. Some kind of relief is likely coming. Next thing we can point to here is if we've got our VIX and PCC extremes, we can see, and we'll have to come over to the PCC to do this. So let's load those up while we're here. Right. So let's just bring up this group of extremes. So let's remind ourselves where we are for the moment. This extreme reading was on the 26th of October, and there's the 27th of October, 26th, 27th of October. So the PCC has come back up to, you know, pretty extreme fear / bearishness state. We came down in this free, we whipsawed back up to these high levels here and continue to set extreme readings right before backing off. So we've come back to very bearish put to call conditions. Now let's have a look at the VIX. Now I can hear people saying, oh well, this is all well and good in hindsight. I know it's in hindsight, right? And I get that it's all well and good in hindsight, but we only learn to look for more stuff when we practice this. We start to think, well, what should I be keeping my eyes on? Now, the VIX here is a little tricky, to be honest. There's a slight downward trend here. Maybe you could argue there's a trend line here. But it did get elevated somewhat, but only up to 23. It didn't look like it was coming back to anything specific here. So in that sense, you'd be forgiven for thinking, well, the VIX is going up, but there's nothing saying it has to stop here. Alright, but we know relative to the recent lows, okay, that the VIX was getting elevated. around late October, relative to where it's been in the last month or so, or the last 4 or 5 months. It's relatively elevated, but it's not by any level getting to extreme conditions. It just doesn't want to nowadays. It's just been in a downward trend for a long time. So the VIX is elevated relative to where it's been recently. PCC is back at extreme levels, and then we've got breach of the 250, divergence on both the daily and the 4-hour, major volume node, major point of control, major horizontal support level, 61.8% retracement, and in fib time as well. You hear what I'm saying? I know I'm labouring this point, but I'm just trying to make the point, which is, I remember how bearish everyone was getting when this was breaking down here, and they were all wrong to be getting bearish. It's when everyone gets bearish that we have to stop and look at the chart for a minute and go, well, wait a minute, are we a little overdone? Should we really be anticipating the opposite happening? Now, I was seeing some counts at the time which were 1, 2, 1, 2, 1, 2 to the downside, anticipating a total implosion, right? But does that really make sense with everything we've seen here? Divergence into these lows, major support. Does that really make sense that we're now going to implode? So just be careful that you don't get carried away with either your own count or your own bias, which we can all do. I do it myself, you know. But we try and keep an idea on the classical analysis as well, the basic analysis. We put the Elliott wave back in its box for a minute and stop obsessing over trying to count things and just look at the chart for a bit and see what we can see. All right, so that concludes the classical analysis section. I don't think there's anything else to discuss now, to be absolutely honest with you guys, because we've already touched on the PCC having come back to extreme conditions. The 60s back up of the 250 on the exponential moving averages. We have not set new line graph extreme readings beyond where they were, but they did get pretty high. We would now anticipate perhaps a little bit longer around these extreme conditions, because sooner or later that market is going to correct. Okay, and that will create a little bit of fear and might elevate the VIX slightly, just slightly again. Now, in the meantime, we're expecting the count to stay above that 409.21 level. If it breaks that level, then we have to reconsider. We've got alternatives as to why, but we are breaching that low, and we are likely going to see future more lower price action and more bearish conditions prevail. If we stay above that level, we're expecting some of these gaps to get repaired in the chart, some retracement back into this prior territory, and then further moves on as we push for new all-time highs. So that's it, guys. I'll leave you there. All the best. Take care of yourselves, and if you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases, and as always, feel free to leave us a comment in the comment section below. And take care of yourselves, and I'll be back with you as soon as possible. All the best. Bye bye.